Microsoft stock jumped 8% after it reported earnings, and that Azure crossed $100 billion in AR. Let's take a look.
Today, we're unpacking Microsoft's Q4 Fiscal Year 2026 earnings. The entire tech world has literally been holding its breath to see if the billions being poured into this AI arms race are actually paying off. So, let's look at the data. Heading into this report, there was this heavy cloud of anxiety hanging over the industry. Investors, analysts, everyone was asking the same trillion-dollar question. Is Microsoft's enormous AI investment actually generating real financial returns, or is this all just one giant speculative bubble? It's arguably the most critical question in technology today, and this new data finally gives us a concrete look under the hood.
Well, the answer? It appears to be a resounding yes. The market's reaction was absolutely explosive. Microsoft shares shot up roughly 8 to 9% in after-hours trading. That jump added $250 billion in market cap almost overnight. That is basically the equivalent of finding an entire Netflix hidden in your couch cushions. So how exactly did they pull this off?
Okay, let's dive into this. Microsoft delivered an absolute monster of a quarter. Revenue hit a staggering $90 billion, and that beat consensus estimates by $2.4 billion. Net income rocketed 31% to $35.8 billion, and diluted GAAP earnings per share followed right along, up 31% to $4.81. Their operating performance is simply firing on all cylinders, and that's even with this unprecedented infrastructure investment happening in the background.
So breaking down that $90 billion, we can see exactly where the heavy lifting is taking place. Productivity and business processes pulled in $36.8 billion. But the absolute powerhouse here? The intelligent cloud segment, generating $39.3 billion. Meanwhile, more personal computing brought in $13.9 billion. Now, gaming did see a slight decline because of the ongoing Xbox restructuring, but honestly, that drag was completely overshadowed by the massive upside from the cloud and productivity arms.
Which brings us to the real core of the excitement, the Azure and Copilot boom. Let's look at the specific evidence of enterprise AI adoption, because this is where things get wild.
The biggest surprise of the entire quarter? 43%. Coming into earnings, the broader market expectation was that Azure's growth would come in right around 40%. Instead, Microsoft reported that Azure revenue grew by 43% year over year. It actually accelerated rather than slowing down. Beating analyst expectations by several percentage points at this massive of a scale is incredibly difficult to pull off, and it proved that demand for enterprise cloud and AI capabilities is actually gaining speed.
And that leads us to this just monumental number, $100 billion. During this fiscal year, Azure officially generated more than $100 billion in annual revenue for the very first time. Just to put that into perspective for a second, if Azure were its own country, its GDP would be larger than a lot of actual nations. It's completely evolved from being Microsoft's secondary cloud platform into one of the largest enterprise software businesses ever built.
But you might be wondering, what about the software layer? 30 million paid Microsoft 365 Copilot seats. Skeptics have been really questioning whether enterprises would actually pay premium prices for AI assistance, or if it was just going to be a passing novelty. Well, 30 million paid individual user licenses proves they absolutely will. AI is officially an incremental software revenue stream now, not just a massive operating expense. They are successfully monetizing AI right now through these higher-value software subscriptions.
And the crazy part? The momentum isn't stopping. After that 43% actual growth in Q4, Microsoft guided Azure growth to roughly 45% for the next quarter. This forward guidance suggests a wild reality. Customer demand for cloud AI is actually exceeding Microsoft's ability to build the capacity. The demand is quite literally outpacing the available supply. For a company investing as aggressively as Microsoft is right now, that is a highly, highly lucrative position to be in.
But, every arms race has a hidden cost, right? Let's pivot to the plot twist. The monumental financial weight required to actually sustain all this AI infrastructure expansion.
Now, what's really interesting about this is the contrast. We just celebrated that phenomenal 18% revenue growth. But here is the stark reality of the AI era. Capital expenditures exploded by a staggering 70%. Yes, revenue is growing fast, absolutely. But the cost required to build the underlying infrastructure is growing vastly faster. To put a hard dollar figure on that 70% explosion, $41 billion. That is what Microsoft spent on capital expenditures in a single quarter. If you annualize that, you're looking at one of the absolute largest infrastructure investment programs in corporate history.
They're dropping tens of billions on data centers, networking equipment, and GPUs. Investors have largely accepted this massive spending spree because, as we saw, the revenue is accelerating, but the sheer scale of the check being written here is just breathtaking.
The direct result of writing those massive checks is that free cash flow remains under pressure. I mean, Microsoft is obviously still a financial juggernaut, but this historic AI spending spree is definitely eating into their cash generation. If customer demand for AI ever cools off, sustaining these investment levels is going to severely impact the bottom line. For anyone watching these tech giants, that cash flow pressure is the prime risk metric you need to be paying attention to moving forward.
It's also super important to objectively note where some of these earnings benefits actually came from. The core operating business was undoubtedly excellent, sure, but the headline earnings per share was modestly boosted by about $3.2 billion in non-operating gains. This specifically came from unrealized gains on Microsoft's investment in Anthropic, along with some lower restructuring costs. It doesn't diminish the incredible operational quarter they had at all, but it's a vital piece of the financial puzzle when you're evaluating exactly how they arrived at that final net income number.
So, bringing this all together, what's the verdict? It really seems like Microsoft has found a durable path to monetization. They've provided the strongest evidence to date that AI infrastructure spending actually translates into measurable, real-world business performance.
The absolutely crucial point is how they're doing it. They aren't just relying on a single trick here. They're monetizing AI through multiple channels simultaneously. We're talking higher Azure consumption for training models, premium Copilot subscriptions, AI-powered enterprise apps, and infrastructure for third-party providers. This diversification makes their AI business structurally robust and just far safer than companies relying on a single isolated revenue stream.
Just to summarize the core takeaways from this explainer, Azure growth is actually accelerating, not just holding steady. The rapid Copilot adoption proves enterprises are more than willing to pay. Their commercial cloud backlog increased to a record $678 billion, and management is confidently raising their forward expectations. Together, this data significantly reduces the fear that hyperscaler spending is purely speculative. Enterprise AI demand is currently strong enough to absorb this massive investment.
Which really leaves us with one final provocative thought to chew on. If $41 billion a quarter is the new price of admission to win this AI arms race, who else can realistically afford to compete? The barriers to entry in tech have just been raised to astronomical heights. It's a fascinating landscape, and it's clear the rules of the game are being rewritten right in front of us. Thank you for joining me for this explainer, and as always, keep questioning the data.